All right, everybody, thank you for joining us and welcome to today's webinar, How Do You Manage a School During a Scale? My name is Hannah Zwick and I'm the Director of Marketing here at CourseKey, and today we're joined by Tom Hartman, CFO. Tom has experience both within career college boards as well as the industry, and without further ado, I'll turn it over to him to introduce himself and take you through today's presentation.
Hello, folks. I trust that everybody is having a wonderful day. I apologize if I sound a little scratchy or mute occasionally. I am working remote today because of a cold I came down with in the last 24 hours. So apologies if it's hard to understand at times. You might ask your question, why am I qualified to talk about what happens in a recession, whether recession is going to happen, and what happens to a school. I guess probably three historical experiences. One, after getting an electrical engineering degree, I did get an MBA from Wharton in finance and working in commodities, so was very attuned to the economic indicators that led to recession. But like all economists, no one quite knows. We'll just lightly touch that topic. In terms of rapid scaling, I have operating experience both in a career ed school as a board member, observing what happened to a team during the Great Recession and as they scaled their operations rapidly. I also have experience in other industries during a rapid expansion of a company from essentially a $27 million plan to a $65 million reality in 6 months. Which required lots of scaling very rapidly and firsthand experience watching things break down or the organization struggle. So with that, that's my background. That's why we're going to talk about, or at least that's why I feel qualified to talk about some of this. And with no more of a laboring, let's start with our first slide. Oh, wait, well, Hannah?
Yes, did you want to do the poll?
Yeah, let's do a poll beforehand.
All right, great. All right, everyone, we've pushed out a quick poll for you. Do you think a recession is coming, and if so, how soon?
And it's I think a great question, because there's lots and lots of noise out there regarding the next recession, its timing, and its practical realities in our current environment.
All right, let's give it a few more seconds. All right, I'm gonna give it 7 more seconds and cut it off at 45 seconds. Okay, great. So it looks like everybody online has voted that they think a recession is coming within 1 year.
It's funny being in an industry where the recession actually historically helps the industry, and in every other sector I've ever worked in, we don't root for recessions, which is an interesting contradiction. So let's talk about the historical perspective on recessions and their impact on post-secondary education enrollment. So the first graphic captures the most notable economic recessions beginning in 1929, which was in fact the Depression, up through the recent Great Recession in the 07 to 09 period. The point to note here is the GDP decline, or the gross domestic product, which is the productive element of the economy, is defined by a recession defines a drop in that, and you can see that there is a correlation between declining GDP and increasing enrollment in post-secondary education. The most recent one, we saw a 5% reduction in economic activity, or GDP, and the boost in enrollment during that period was 15%. And that's for all post-secondary. And interesting reasons for past recessions too. Next slide. How likely are we to have a recession? As I mentioned a few moments ago, lots of information out there, lots of noise regarding how soon, when, and how it'll hit. I'm not going to wage a guess beyond just balancing the indicators, those that are suggesting we're going to have a recession and those that are suggesting maybe not as fast as we think. On the for a recession side, I think the ones that stand out to myself and probably most economists, the inverted yield curve is constantly in the press. And historically, the beginning of an inverted yield curve is a precursor to recession within, on average, of 12 months. And I believe the yield curve inverted about 4 or 5 months ago. Also, we've got the longest expansion on record. And when the economy expands for a long, long time, there's a moment where consumer sentiment changes. And I think that's a strong reason for a recession coming on. The trade war with China hasn't helped, as it's pushed down manufacturing activity and manufacturing growth, which trickles throughout the entire economy over time. Now, indicators against the recession, job growth continues to be fairly strong, though there was a report this week that suggested the new job ads were over 200,000 in the last reporting period, were 145,000, I think, this period. So, while it's a strong job growth is a positive, it's some caveats around that one. Wage growth is starting to hit the market. That does spur consumption, and GDP is fundamentally 70% consumption. So pros and cons, anyone who's thought within the next year the recession will hit, I would personally agree with that. Did we have a poll around here? No, I don't think we did, Hannah, did we?
No, we did not.
So let's move on. Another historic view, something that most people have probably lived, is how recession and enrollment tracks in post-secondary education. Just another proof point to the earlier slide. The green bars represent recession periods going back as far as 1970. This data came from a BMO capital markets study. The blue curve shows the change in the unemployment rate, and the bars show the change in enrollment in post-secondary ed. It's a very, very clear correlation between rapidly changing unemployment and rapid growth in enrollments within post-secondary ed. I think most of us probably have heard or seen that or experienced it, but this is data that shows it's very highly correlated with unemployment. And this was post-secondary ed, so let's take a closer look at career. And this really just focuses on from 2000 to 2015. And I'd highlight the beginning of the recession was around 2006-07, and the growth was pretty rapid in career 2-year and shorter enrollment. That's actually a 34% increase from that from 06 to the peak in 10, which is even greater than the 15% in the first slide. So again, the takeaway there is recessions and economic slowdowns drive enrollment, and career schools traditionally, or at least in the last cycle, receive a greater share of the benefit. And we'll go forward to another piece of data that came out of the BMO capital markets, which showed in the top section, this is total enrollment by school type. This was for 4-year schools. This is 2-year schools and less than 2-year degree granting or certificate schools. Interesting is the change in enrollment the year prior to the beginning of the recession, the year of the recession, and the year after. You can see that the 4-year school growth somewhat moderated, a little bit of a boost, but not huge. But you step down into the 2-year career schools and the less than 2-year certificate or diploma programs, much more volatile and much more reactive. Specifically, the 2-year career schools start picking up with slightly prior to the recession, and some schools may be seeing that right now. From our experience, we're seeing schools, some of them picking up enrollment right now. On the 2-year or less than 2-year degrees, it actually is sort of a delayed start and happens the beginning of the recession. So interesting data that sort of all paints a story saying if a recession hits, activity is going to expand separate from anything that's happening politically or legislatively. This I find interesting because it raises the question, How is this going to affect operations? Do we have any insight on how this affects the running of a school during a rapid growth in enrollment? So we'll go to the next slide. This one takes a little bit of explanation. What I've done here is looked at some schools and what happened during the last recession, starting in '06 and up to 2011. And I normalized or indexed each of 4 metrics. So for example, population, if the school had a 500 student population and then grew, I divided each of the actual population growth by 500 the base year to sort of see the relative speed of increase. Did that for population, instructor spend, how much money we spend on instruction, administrative spend, which would include all levels of administration, and an interesting metric, how much space we have per student, which often signals some crowding and need for additional space. You might want to look at the data for a second, but let me provide a few insights from my perspective. As expected, we had a rapid growth in index population. In fact, in this metric, it suggested the population of the schools collectively grew 3.5 times from '06 to 11. That's probably a larger number than one might expect, but indicative of a change. And as not surprisingly, the index for instruction spend sort of parallels the population growth. We can only take so many people per class. At some point, we need to expand the instructor base, and that sort of happened mid-recession. Interestingly, it overshot when the recession slowed down and population growth slowed down. The spend leveraged, and that took some money out of the operations. Administrative spend goes up slower than instructor because we're delivering the service to handle the population, and we try to do it with the same staff we currently have, the same space we currently have. And then, as you wouldn't be surprised to see, the square footage per student declined precipitously, and you get to a point here, and a school I would suggest had to make adjustments in space, maybe take down temporary space, start paying premium dollars for things. So the indexes are pretty interesting, not only in the way they scale with population growth, but the way they sort of catch up as population slows down. And all of that raises a bunch of questions, which we'll address in some follow-up slides. And of course, ask some questions as we go along. I'm hoping I'm explaining this clearly for everyone. So what happens during a period of rapid growth to a school? Operationally, and I'm sticking with operations focus here, you're in the day-to-day. Often as you increase population, you increase the workload of the organization and processes break down. People shortcut things to get things done quickly. We also have an increase in staff costs because we're hiring more support, as the administrative number suggested. Where the new support staff maybe doesn't understand the policies, maybe people are shortcutting policies, so we get into periods of reworking data and maybe running premium time and overtime to stay up with the workload that registrars and instructors may be dealing with. It creates a stressful environment. Putting a lot of time in, feel like you're never catching up, can lead to higher turnover, stress causing people to say, I don't need this anymore. And they may move on, and that puts pressure on management to respond to it. Personnel issues. As you bring in new people on short notice, it changes the culture. Outside the training problem, people have different attitudes and approaches to working from past experience. Your existing staff may feel maybe less powerful, maybe they're not being heard as new people show up. So it creates some culture challenges. Continuing on, the coordination difficulties. We're reacting to things because everything is accelerating. The paper being processed is moving faster. The student challenges are hitting us more quickly. So everything becomes a little bit more of what I'd call a reactive job shop environment rather than a smooth process that we might see when enrollments are lower. HR stress can increase in all of this. As more people show up in HR, we run risks of dissatisfied students, dissatisfied staff. That also can lead to legal risks that grow during periods of high activity, but maybe don't manifest themselves until things slow down. Of course, during all this hectic activity and with processes breaking down and new individuals coming in to help, we can have a growing concern around our compliance. In fact, in the last cycle, I think a lot of schools struggled with different elements of compliance because the record keeping probably took a hit, and accreditors stepped in and noted it and put schools in a more precarious situation, which is, as we all know, quite expensive and quite painful, pulling together all the records in advance of any type of program review or accreditor visit. One last page of these. People moving in and out of the organization quickly, being assigned in different places. Some of our quality or the training we do to get people up to speed on processes can take a backseat to simply getting the job done. Scheduling, of course, can get more chaotic. Classes can grow, students can move around. We're just, again, chaotic environment. Pressure develops, as we said earlier, on future costs as we're sort of throwing bodies and money at dealing with scale, as opposed to a time of slower enrollment growth where we have more stable processes and not as much challenge managing our teams. And finally, new hire difficulties can emerge. It's dealing with monitoring how they're doing and the strain in the workforce. So lots of issues here, some of them which are sort of have similar themes. I guess I'd be curious to see or to understand what the attendees' perceptions are as the most important or challenging elements here. Do we have a poll we can send out, Hannah?
Yeah, we sure do. All right, same thing as last time, everybody. We'll spend about 45 seconds to a minute on this, and this is a multiple selection one, so feel free to choose all that you think are large risks. All right, we'll give this a couple more seconds. All right, it looks between our voters that our biggest risks we see are process breakdown, HR stress, and chaotic scheduling.
Boy, that sounds very familiar. Before I go on the next slide, I'll share a story from the company I mentioned earlier, which scaled from 27 million in sales to 65 million in 6 months. When I entered that company to run it operationally, things were moving so fast that we would have a planning and scheduling meeting almost daily, probably more like every other day, in which we'd come in with stacks of paper. And it would be a 4 to 6 hour meeting going through what has to be prioritized and what actions we have to take to keep the business running. It was a massive suck or drain of time for all of us. And then 2 days later, we'd come back and report on what had changed. And it was hard to do your regular full-time job when you spend so much time in a planning and scheduling meeting. So I've personally felt that pain. So we've described a period of time here. A recession hits, enrollment goes up sometimes significantly. Our operations are stressed to expand to that growing student population and still hold true to a quality, to retention and quality outcomes. And we tend to throw historically both money and bodies at processing the information we need to process during these periods of time and communicating with everyone. And what kind of questions might we start asking as leaders or people on the front lines doing day-to-day activities. Now, here's some questions that came to my mind. You might want to look through that list on your own. I think what jumps out to me, what's falling through the cracks and the resultant compliance risk. Are students and instructors working as a team, and the coordination piece? Interesting list. I don't know if anybody wants to respond and provide a comment and questions as to what jumps out on this list, or did we have a survey on this one, Hannah?
No, we did not have a survey on this one.
I'll let you consume it, but it really speaks to, by moving fast, by spending more money, what are we doing to our future from a profitability perspective, and what risks are we taking on in order to address today's challenges of a growing student population? A lot of this stuff, a lot of these questions in my mind are trying to get less reactive and more proactive to the situation at hand. And again, if I were to underscore from personal experience, what happens during highly fast scaling moments is we simply are moving so fast that we're reacting and always feeling behind the 8 ball, as it used to go, or like a squirrel running in a cage trying to catch up, and seldom have the time to proactively manage the situation. Which lays a question, how can we handle that? What I did at that company earlier that I mentioned is I developed a software solution that would simplify and prioritize the scheduling process, reducing 4 to 6 inches of order review into a single page of priorities, so that we spent less time making sure everybody was on the same page and more time reacting to what was a common set of priorities. So again, I would suggest that the technology, from my experience, proves to be a great way to get more proactive in the management of a scaling environment. So it becomes, what kind of technology you want to look for in this situation. Allow me to brainstorm some thoughts, and I'll let you read the details below it, but we want to find technology that can capture data more efficiently. The last thing you want is a lot of paper systems running around, not getting filed, creating piles, losing the piles. All of that hurts compliance. And it also requires more manpower often to process the paper. Better control of operations, knowing what to take action on. Again, in the case of a school, being able to intervene quicker with student issues, protecting your retention numbers, anything that gives us insight into how operations are moving forward is a great thing. Doing it in real time. The old word for non-real time would be sneaker net, where you'd write a report and run it down the hall or send it via email and then hope somebody finds it. Anything that can roll up data real time, and the most critical data within any operation, turn it into a dashboard, make the dashboard accessible to decision makers and managers, and facilitate better and quicker reaction. Without as much manual entry is a big benefit. If a system can provide that, you don't need to worry about the quality of data quite as much. Other things, empower continuous improvement initiatives. If you buy the right technology, not only do you simplify or at least streamline your operations and make quicker decisions, but it also can lead to metrics, and the metrics can lead to insights which help you improve your operations long term. It's interesting thing about data and information. The more you collect, the more insight you can pull out of it if you have time to analyze it. And too often we don't have time to analyze it. Thus, the software you want to use should simplify analysis and turn your insights into actionable behaviors. You want your technology to selection to facilitate new lines of communication. When I was growing up as an electrical engineer, it was mainframes and minis, and everything was RGE terminals, so very slow systems. It's a different world today. We have mobile devices everywhere, IoT, collecting insights, all of which gives you more and new, unique, creative ways to integrate data into your decision-making process, all in support of higher retention, higher student outcomes, and ultimately serving your local employers better, while keeping your compliance and regulators happy. Also, if you use the right technology, it definitely can have an impact on the perception of your school and institution in the marketplace, so can lead to differentiation. If you do technology better than others do it, if you do it more holistically, if the student experience is better, if the externship sites, should you have those, are more pleased with the ease of working with your organization, you create loyalty, you create some differentiation as a quality operations, and it's just going to come across as an organization that's in control. And that helps all of us. You can probably see lots of examples in the real world where mobile technology these days has helped organizations appear more streamlined, more efficient, and more customer, consumer, or process focused. So there were 6 of them here. If I go back, I think in technology, is that correct? I think we had, yes. 6 areas. We'll ask the same question again from each of your particular perspectives. Which of these 6 are most relevant when you think about technology being applied in your operations?
All right, the poll is live, so everybody take a minute or 2 to go ahead and answer that, and then we'll discuss. And it is another multiple select, so feel free to choose, a couple if there are a few that you think are equally vital. All right, let's give it about 10 more seconds for any last second answers. All right, and everybody who responded has agreed that more efficient and accurate data collection would be the largest value. Trailing behind that, we've also had submissions for better management control of operations, empower continuous improvement initiatives, as well as institution differentiation in the marketplace.
Hannah, you broke out for me in the middle of that. Could you repeat those for me, please?
Absolutely. We had 100% of respondents say more efficient and accurate data collection. And then behind that, we've also had submissions for better management control of operations, empower continuous improvement initiatives, as well as institution differentiation in the marketplace.
Great. So, that's kind of fascinating that everybody jumped on the data collection of accurate data, because that's so underpins. It's sort of the garbage in, garbage out question. So the final slide is sort of an open Q&A. Let me summarize. Again, this only took 30 minutes, so either I talked very fast or didn't have as much to say, or I'm hoping we get some questions and have a little dialogue around them. I think the point you'd want to underscore is, the first question is a recession coming, and how soon? What's that impact of a recession going to be on your school in particular? And how are you going to manage proactively that impact in your operation, and can technology help that? And if technology can help it, then I'd encourage listeners to consider making the decision in advance of the upturn, because if you choose to solve the problem with technology during the ramp up period, all you're doing is adding more stress in the organization. While the money might be easier to do it, the stress and the workload can be a little harder. So if you're thinking about using technology and considering it in advance recession, boy, now would seem to be the time the forward-looking school would address it. So with that, open it to Q&A.
Great, perfect. And as Tom said, we're going to take some questions. So if you haven't submitted any yet, please do so now. Tom, the first question we have while others contribute is, what do you think the space would look like today if more tech options were available during the last recession?
Now that's a really interesting question. Having sat on some boards in career school education, I think in the context of a challenging government agenda or federal government agenda around Title IV funds and the financing of proprietary ed schools, I think there was a lot of pressure to prove placement data, prove outcomes, and document it accurately. And I think there was some, at least from my experience, there was the lack of transparency, the heightened sensitivity to those figures put some schools at risk and put more of a negative perspective on the sector. It could have possibly fought back by having a more transparent, consistent view of outcomes, of progress, of using technology to standardize the way you collect and present the data. So I think certainly would have been a lower, might have lowered the political pressure moderately, not a ton, but some.
Great. And then we've also had a request to go back to the indicator slide and for an overview on which one you think is the biggest indicator for a recession and why.
This being the slide we're talking about.
Oh, yeah.
I think this is it. If I were to pick out one, I think it's probably two ones on this list. There are a lot of them. There's a lot of micro data out there. Everything changes daily, but the combination of the inverted yield curve and longest expansion on record. One of my graduate school experiences was sitting in an economics class and the professor describing recessions and inflationary periods as GDP that differs from quote unquote GDP potential. And I asked the question, and GDP potential was set at a slope of annual growth at around 2.4% back then. And my question was, what causes it to be 2.4 and not 2.6 or 2.8? And the response was it's population growth. And when you think about GDP, 70% of the indicator is consumption, which is population. The current projection for the US is, I think, about 1.9 or 2% is GDP potential. So that's the rate at which we should be growing as a country every year or every quarter. Anytime you grow faster than that, you're overproducing and it's inflationary by nature. And when you're growing slower than that, it's recessionary and there's just more unemployment, more economic contraction. And it's cumulative. So when you look at long expansions, it tends to put the economy above the GDP potential line, which eventually has to be brought back down to the nominal line. So I think long expansions cause a problem, and we have been, that's why they're sensitive to inflation. And then the inverted yield curve means people don't want to invest or don't want to lend money in short term at lower rates than long term. A normal yield curve would say that if I'm lending money for 1 year, I should expect a lower return because they have a less risk and a lower interest rate than a 30-year loan, which should be more risky. In an inverted yield curve, the short-term rate becomes higher than a long-term rate, which means less investors are a little bit uncomfortable lending out money in the short term relative to other investment opportunities, given default risk and a perceived economic slowdown. So long expansion, inverted yield curves both signal a recession is coming. The inverted yield curve would suggest within 12 months of the event, which says sometime in the next year. Long-winded answer to a really interesting question.
Great. And then we've had the next question is, would you suggest hiring more staff members or allocating those dollars toward more tech? Maybe a mix of both.
Great question. And boy, as a school operator whose purpose in life is to train and help employ individuals, it does suggest that the humane thing to do would be to use people. Unfortunately, in the regulatory environment we're in, and with the management and training requirements necessary for new hires, I believe technology, if deployed correctly, can greatly enhance the productivity and the decision-making in an organization. So if you have time, my first inclination would be to invest in the right technology and then supplement staff as needed. I think from my experience as well, when you put the right technology in place, you start collecting data and insights that one hadn't thought about in advance. And all of a sudden, new initiatives for continuous improvement pop out, and there's still an interest in having the right resources in a company to manage that. So, long way of saying it's probably a blend, but I'd start with the right technology and then scale according to the technology.
Wonderful. And then next up, we have, how do recessions impact small career schools versus large career schools?
I don't know I have any data to differentiate the two. And whoever asked that question, I'd love them to provide back a perspective. But when I was on the board of the larger career school, I used to view the business as a location for training that serves maybe a 30-mile radius of potential students around it and a 60-mile radius of potential employers around it. I think a smaller school by definition would have higher touch in theory over a larger school that may be more process driven and maybe a little touch driven. I'm thinking out loud here. No data, but I would think fundamentally it doesn't really matter if you're a small or large school. You should see a boost in attendance if your brand's solid and your outcomes are solid, and you have a culture that entices students to continue their journey.
Great. Well,
not so great on that one. That was a long ramble, but that's the best I could come up with at this point. Good question.
Fair. Well, it looks like that might have been our last one. If anybody in the audience wants to get in another one real quick, we do have a bit more time together. So I'll give you fine people another minute to decide if you want to put something forth. Otherwise, we can start to wind down. So I'll give you guys another 30 seconds or so.
Hey, Anna.
Yep.
As we're doing the final 30 seconds, it would be interesting, or do we do a poll afterwards? I'd be interested in what the listenership thought about the content, what's missing, what could have made it more interesting, et cetera, or whether it hit the spot for them and gave them something to think about.
So we do have a post-event survey planned, but the polls are restricted to being multiple choice or multiple select.
Perfect. Okay. Thank you.
Perfect. And on that note, nobody has submitted another question. So we will say thank you. Thank you to everybody who attended today and for spending part of your morning or afternoon, depending on time zone, with us. Thank you to Tom for sharing your expertise as well as putting together this presentation. Everybody, our next event is going to be CourseKey's first virtual summit on future trends in education. That's going to be on October 18th. You can check your email. You should have a notification announcing the lineup there. Please register. It's going to be a fun day full of events. And if you do want to subscribe to, be aware of more webinars as they come up every month, you can subscribe to our newsletter online at CourseKey.com. And again, thank you for spending some time with us, and thank you, Tom.
And thank you.